Hey, welcome back to Lunch in the Market. We're going to talk today about lopsided butterflies. A normal butterfly means that you have either a long call spread and then a short call spread of equal width. Say you thought a stock was going to go up, but it's not going to go up to infinity, so you pick a resistance point, say $70 or $80 on Walmart. So you buy the 75, 80 call spread, and then at the same time you sell the 80, 85 call spread. So essentially, your ideal way to profit is for Walmart to get pegged at $80 a share. Your butterfly's worth $5, and then that's the ideal situation in a butterfly. Okay, the issue or the difficulty with butterflies is to get max profit, you need to peg it to a certain level. In our example, we used Walmart at $80. That becomes the body of your butterfly. So you sell two $80 calls, and then you buy a 75 call and an 85 call. Essentially, as long as you're on the north side of that, say Walmart's above $80, then there's value to your butterfly and you're okay. The value begins to diminish as you go past $80, and then obviously at 85, above 85, your butterfly is completely worthless. Say you paid $1.40 for your butterfly, you're good as long as Walmart doesn't go above a dollar. So 83.60. You're okay until 83.60. You can still break even. Above that, you begin to lose money. The other way that you lose money is if Walmart were to fall below $75 a share, right? You paid $1.40. You own essentially a 75-80 call spread, and if Walmart isn't above $75 a share by at least $1.40, so you need 76.40, right, to break even below the middle of your butterfly. That's how a traditional butterfly works. So what we've done is we've kind of been doing lopsided butterflies. You can use them on the put side and you can use them on the call side. URI is a stock that moves wildly all over the place. And so we initially put on a, what do we do? I think August lopsided call butterfly. It was, let's see, where's URI trading at right now? Okay, so United Rentals, ticker symbol URI, it's trading at around $37.84. Okay, so I think we owned the 30, 40, 42 and a half call, lopsided call fly long that expired in August, and the stock cratered and the top side. So what we had done, right, is we had bought a 30 strike call and we'd sold two 40 strike calls against it and then bought a 42 and a half call to protect ourselves. So you're essentially long. See if I can depict this. Your long side of your fly is much longer than your short side of your fly. So what it's designed to do is, even if the stock goes all the way through your entire fly, okay, you still make money. So how does that work? So let's say you put this trade on right now. How much would you want to pay in order to do a 30, 40, 42 and a half long call fly in URI? Okay, so the short side is 250. So the max that this trade can go against you, right, minus losing what you pay for it and having the stock finish below $30 a share. But let's say it doesn't. Let's say it goes all the way through. Stock goes to $50 a share. What's your call fly worth? This was the question that we had on Twitter the other day, is how the heck do these call flies work? How do you figure out how they're profitable? So we're going to answer that question. So max loss on that short side, right? This is a short call spread, 40, 42 and a half. You use this to reduce your costs on your long call. But you don't want them to be even, because then if it blows all the way through to the upside, your trade is completely worthless, because you'd gain $10 over here, but then you'd lose $10 over here if they were even, and therefore the fly wouldn't make sense. Especially if you thought there was big upside. You can also do this on the downside. Before Apple reported, we did a long lopsided put butterfly, where the long side of our put butterfly was like $25 a share, and then our short side was quite a bit smaller. So even if Apple blew all the way through the whole put fly, we'd still be profitable. And here's how. Let's say it cost you $6 to buy that $10 fly in URI, but you get paid $2 to sell the short side of it, right? So this side's worth $2.50. This can go against you. This side you pay $6 for. It's actually worth 10. Okay, this is where your gains are going to happen. Obviously, ideally, on a 30, 40, 42 and a half long lopsided call fly, you want this thing pegged at $40, right? Then the structure is worth $10. How much did we pay? Remember, we got paid. We took in $2 to sell this part, and we paid $6 for this. Net, we only paid $4. $4. Okay. What if this thing goes against us? Stock goes to $50 a share. It goes gangbusters nuts, right? Breaks all the way through all the strikes on the fly. Net, you're going to lose $2.50 here. You're going to make 10 here. Net's worth $7.50. Hey, you only paid $4 for it, right? Max profit when it goes all the way through the fly. The structure is worth $7.50 if it breaks all the strikes to the upside. Not bad. Your max loss is, of course, $4. It's what you paid for the whole structure. If URI went completely south and managed to go back below $30 a share, then you lose your $4, right? Which is $400 because you have to multiply everything in options by $100. Okay, so it's not a bad trade. Okay, you have a great upside. The stock isn't at $40 yet, so you have $3 of potential improvement. If the stock finished right here, right now, at $37.87, your call fly would still be worth $7.87, right? Which was our max profit. It went all the way through. You paid $4. It's worth $7.87. It's a great situation. So that's how the lopsided fly works. What you want to do is make sure that when you buy the structure, right? Let's say you're doing a put. You do price line before earnings or something. Some stock that moves a ginormous amount. Apple, Google, Priceline, CF Industries. Think of something that's a big dollar stock that's going to make a big move that on a percentage basis it's not real big, but on a dollar basis it's massive, right? Apple loses $25 a share. It's really no big deal. But in the options world, you lose $25 a share, it's still $25 a share. And multiply that by 100, right? It's big money. So you can use these options that have huge premiums to create lopsided flies on either the call side or the put side to help you make cheap bets. Somebody asked me the other day, how do you protect a caterpillar? I bet today that 85, 80, 77 and a half long put butterfly, lopsided put butterfly for a caterpillar, I bet you could buy that for maybe around $1, maybe $1.20 or something like that. Okay? Ideally, if you protected that, you'd want Caterpillar to go all the way back to $82 a share. If you do, your long lopsided put fly would be worth $3, right? Because you're long at 85 and you're not short until 80. If it went down to $82, your long lopsided put fly would be worth $3, almost a 300% return. You can see the power. Obviously, if it doesn't go anywhere near the direction you want it to go, you could lose the premium that you pay, but that's pretty much why you're using options, so you can quantify your risk. You already know what you're going to lose up front when you click the button. Okay? That's the beauty of options. You know how much you're going to either make or lose because you pay for them, and you decide how much you're going to pay. Okay? All right. Hope that helps. Be sure to leave comments if you have questions. Hit us up on Twitter if you have questions. We can do a follow-up video. Hope that helps explain what we're doing when we're talking about lopsided calls, put side and call side. All right, thanks for joining us today on Lunch at the Market. Have a great day. See you next time.